On the morning of August 15th, 1971, every finance minister in the world woke up to the same news. Overnight, without warning, without a vote, without a treaty, the United States had unilaterally severed the link between the dollar and gold. $35 per ounce, the rate the world had built its monetary system around since Bretton Woods, was gone. Gone by press conference. The countries that held dollars as reserves suddenly held paper. The countries that held gold held gold. That asymmetry is where this story begins. This channel does not trade in promises. It trades in the forensic record. Today we are going to apply 5 tests drawn from monetary history to both assets, gold and Bitcoin. Not which one will make you richer, which one actually protects you when the system turns against you. Before we go further, nothing in this video is financial advice. This channel examines the historical record. What you do with that record is your decision. Do your own research. Consult a qualified advisor before making any investment. We are historians here, not brokers. The 5 tests. From 4 monetary collapses, the Roman debasement, the collapse of Bretton Woods, the Weimar hyperinflation, and the Soviet monetary disintegration of 1991, we can extract 5 criteria that every serious store of value must pass. Not theoretical tests, historical ones. Test 1, does it survive government confiscation? Test 2, does it survive the collapse of the institutions that support it? Test 3, does it maintain purchasing power across decades, not months, decades? Test 4, does it function without trust in a counterparty? Test 5, can it be held privately outside the financial system entirely? Test 1, confiscation. In the summer of 1944, as the Allied armies pushed east across France, the retreating German administration did something that has been largely forgotten. They attempted to strip the Banque de France of its gold reserves and transport them to Berlin. The French central bank resisted. Some of the gold was moved, some was hidden. Some was buried in locations only a handful of officials knew. The gold that could not be found was not taken. The gold that had a paper trail was gone within days. That pattern, visible gold seized, invisible gold preserved, recurs across every confiscation in recorded history. From the Soviet collectivization campaigns of the 1930s, where peasants who had sewn gold coins into the linings of their coats survived with their savings intact while those who kept receipts did not, to the Vietnamese boat people of the 1970s, who converted their life savings into gold leaf thin enough to hide in clothing and carried their entire wealth through checkpoints that would have stopped anything larger. Now run Bitcoin through the same test. The United States government has seized substantial quantities of Bitcoin. In each documented case, they did not break the encryption. They followed the paper trail to an exchange, a cloud account, an open laptop. The cryptography held. The human operational security did not. But here is the difference the forensic record forces us to acknowledge. Gold hidden from a government stays hidden permanently. It requires no infrastructure to remain valuable. A gram of gold buried in 1933 is a gram of gold today, legible to any person on Earth without a device, a network, or a functioning exchange. Bitcoin held in self-custody is similarly hidden from direct seizure. But it requires a functioning ecosystem to spend. The government does not need to find your Bitcoin to make it useless. It only needs to quietly pressure the banks that connect it to the economy you actually live in. In 2023, it did exactly that. Gold passes test 1 with a condition. Only what the government cannot see is safe. Bitcoin passes test 1 with a stronger condition. Only what the government cannot see and can still spend is safe. Test 2, institutional collapse. In August of 1991, the Soviet Union's financial system collapsed in real time. State banks froze. The ruble became nearly worthless within weeks. Savings accounts that represented decades of careful accumulation were rendered functionally inaccessible. Citizens who held rubles in Sberbank accounts watched them evaporate not through theft, but through the quiet collapse of the institutional architecture that gave them meaning. The people who survived that collapse with their savings intact were not the ones with the largest bank balances. They were the ones who had quietly accumulated gold, coins, jewelry, small bars, outside the banking system entirely. When the institutions failed, the gold remained. It required no bank to clear it, no government to back it, no exchange rate to validate it. A gold coin in Moscow in September 1991 bought the same goods it would have bought in any other city, in any other century. The metal spoke for itself. Bitcoin was born from exactly this kind of institutional failure. Satoshi Nakamoto released the white paper in 2008, 6 weeks after Lehman Brothers filed for bankruptcy. The Genesis block was embedded with a newspaper headline, "Chancellor on brink of second bailout for banks." It was designed as an answer to institutional failure. The question the forensic record forces us to ask is whether it has actually survived one, or merely survived so far. The honest answer is uncomfortable. Every catastrophic failure in Bitcoin's history has been a failure of the human institutions built around it, not the protocol itself. Mt. Gox, FTX, Celsius. In every case, the Bitcoin protocol ran without interruption, while the institutions holding customer funds collapsed and took those funds with them. The protocol survived. The people who trusted institutions with their keys did not. Gold passes. Test 2, unconditionally. It has no institution to collapse, it simply exists. Bitcoin passes test 2 conditionally. If, and only if, you hold your own keys. The moment you trust an institution, you own paper Bitcoin. And paper Bitcoin is worth whatever that institution decides it is worth on the day it fails. Test 3, purchasing power across decades. In 1348, the Black Death killed between a third and half of Europe's population. Labor became scarce overnight. Wages rose sharply. The purchasing power of gold, tracked through the price records of English wool merchants and Italian banking houses, held remarkably stable across the entire period of demographic collapse and recovery. The plague reshaped civilization. Gold's purchasing power barely moved. Economist Roy Jastrom spent years tracking gold's purchasing power across 2 centuries of primary market data. The finding was not that gold is a perfect store of value. It is not. It is that over long enough periods, generational periods, it has preserved purchasing power in ways that no fiat currency in recorded history has matched. The pound sterling has lost the vast majority of its purchasing power since the gold standard ended. The dollar has lost more than 95% of its purchasing power since 1913. Gold is not. But here's what the gold advocates do not always tell you. In 1980, fear was at its peak, and everyone was buying. Then the price collapsed and kept falling for nearly 20 years. A person who bought at that peak to protect their retirement was not protected. They waited 25 years to break even in nominal terms. Gold is a generational store of value. It is not always a 20-year one. Bitcoin's purchasing power history spans 16 years. In that time, it has appreciated more than any asset in recorded financial history and crashed more violently. 4 separate times, it lost more than 3/4 of its value. Each time it recovered to new highs. That is Bitcoin's most honest historical argument. Not stability, asymmetric recovery. But 16 years is not history. It is a data point. We do not yet know what Bitcoin looks like after a 20-year bear market because it has not had one. Gold passes test 3 over centuries with the caveat that it can punish badly timed buyers across decades. Bitcoin passes test 3 over its own short history with the caveat that 16 years is insufficient data to draw any conclusion about generational preservation. Test 4, counterparty risk. In 1923, at the height of the Weimar hyperinflation, a German factory owner named Karl Fürstenberg had deposited his life savings in Reichsmarks at Deutsche Bank. By the time the inflation peaked, those deposits were mathematically worthless, not because the bank failed, but because the currency the bank held had been destroyed by the institution that issued it. He had trusted a counterparty. The counterparty had trusted a government. The government had printed its obligations away. Every link in the chain had failed. The people who survived the Weimar inflation with wealth intact shared one characteristic. They held assets with no counterparty. Physical gold, foreign currency held in hand, not in accounts, real property. Anything that did not require a chain of institutional trust to remain valuable. Physical gold held in your own possession has no counterparty. None. There is no company that can go bankrupt, no bank that can freeze it, no government that can reverse a transaction digitally, no intermediary of any kind. That is not a feature of gold. That is the definition of physical gold. Bitcoin held in self-custody has the same property, with one additional risk that has no historical equivalent. If you lose your private key, the Bitcoin is gone permanently, irreversibly, forever. There is no vault manager to call, no recovery service, no central authority who can override the mathematics. A meaningful share of all Bitcoin ever mined is believed to be permanently locked behind lost passwords and forgotten keys. The paper burns, the vault floods, but the gold remains. Damaged, perhaps. Recoverable, always. Both assets pass test 4 in self-custody. Both fail the moment an institution becomes involved. Gold fails with a custodian. Bitcoin fails with a custodian, or a lost key. Test 5. Outside the system. In the spring of 1979, as the Khomeini revolution transformed Iran, thousands of wealthy Iranian families faced the same problem simultaneously. They had days, sometimes hours, to convert a lifetime of accumulated wealth into something they could move across a border. Real estate was impossible. Business assets were stranded. Bank accounts were frozen or inaccessible. The families that survived financially were the ones who had already done what Iranian merchants had done for centuries, converted liquid wealth into gold. Coins, jewelry, small bars. Customs agents at Tehran's Mehrabad airport were confiscating cash and valuables. But gold sewn into clothing, gold shaped into ordinary objects, gold distributed across multiple family members, crossed borders that stopped everything else. The physical portability of gold in small denominations is a technology that has been refined over 5,000 years of exactly this kind of crisis. It works without electricity, without internet, without a counterparty who understands cryptography, without a government that permits it. A gold coin in Tehran in 1979 was a gold coin in London the next day. Bitcoin's answer to the portability problem is real. A person who has memorized 12 words can walk through any customs inspection in the world, carrying no physical object, and reconstruct their entire fortune on the other side. No scanner detects memorized words. That is a genuine capability. Gold cannot match for large wealth transfers. But Bitcoin requires something gold has never needed: permission, not from a custodian, from the regulatory environment that determines whether Bitcoin can be converted into anything spendable, whether the banks that connect it to ordinary economic life are allowed to operate, whether the infrastructure stays open. In 2023, the US government demonstrated it can quietly remove that infrastructure without touching a single coin. Gold passes Test 5 for storage and small-scale movement across 5,000 years of evidence. Bitcoin passes Test 5 for large-scale cross-border movement of wealth, but fails when the government removes the infrastructure that makes it spendable. What the central banks are telling you. There's a signal worth more than any individual's opinion. Central banks have been buying gold at the highest rate since the 1950s, 3 consecutive years of record purchases. When the West froze Russia's sovereign reserves in February 2022, the effect was immediate. Hundreds of billions in digital holdings were frozen with a keystroke. The gold Russia held physically in Moscow was untouchable, every ounce, because no foreign institution controlled it, because no keystroke could reach it. That gold has since appreciated dramatically. Nearly a third of all central banks surveyed by the World Gold Council intend to increase their gold reserves within the next year. The highest figure since the survey began. Not one central bank in the world has formally adopted Bitcoin as a reserve asset. El Salvador tried. 4 years later, under IMF pressure, it quietly reversed course. The experiment lasted 1 presidential term. The people with the most information, the longest time horizons, and the most to lose are still choosing gold. That is a data point. It is not a verdict. The question. History cannot yet answer. The Iranian merchant in 1979, and the Soviet citizen in 1991, and the French banker in 1944 all faced the same problem. How do you hold wealth outside a system that is turned against you? They each found the same answer, refined across millennia. Gold has outlasted every empire, every currency, every government that tried to control it. The Roman solidus circulated for centuries after Rome fell. The mathematics of gold required nothing from history to keep working. Bitcoin has survived crashes that would have ended any other asset class. The protocol has never been breached, but it has never survived what gold has survived: a world war, an empire's collapse, a government that decided with a single executive order that private ownership of it was a crime. Here's the question to leave you with. Both assets share a version of the same vulnerability. For gold, it is visibility. For Bitcoin, it is permission. The Iranian families who crossed borders in 1979 did not need permission. They needed metal. The question every person watching this has to answer is which threat they believe is more likely in their lifetime. A government that comes for what it can see and weigh, or a government that quietly pressures banks to stop serving an entire industry, leaving the asset intact but impossible to spend. History has produced both. The asset that survived both is the one that needed neither a network nor a government's tolerance to remain what it was. Thank you for watching.